Hello, my name is Linda Abad and I am a tax insurance specialist in Marsh's private equity and M&A practice. Known tax issues can often cause delays in transactions and can even ultimately stop a deal from going ahead if a commercial solution such as a price chip or an escrow mechanism cannot be agreed upon. In this short video, I will take you through a solution offered by the M&A insurance market, namely a specific tax risk policy. In the last 2 years, as tax authorities have become more focused on bringing in revenue and scrutinising taxpayers' filings, the number of inquiries in specific tax policies placed has been steadily increasing. In particular in this video, I will concentrate on the basics of these policies, pricing and excess, and finally, the process to incept. Specific tax risk policies are designed to cover a known or contingent tax risk that has been identified in a transaction. By placing such a policy, you can take a commercial issue of a price chip or an escrow off the table and concentrate on completing the transaction. These policies are bespoke, and as such, the trigger for payment can be drafted to ensure the exact risk that has been identified and in respect of which a tax authority could make a claim against the taxpayer. This could be a general concept, for example residency, or a claim pursuant to a specific piece of tax legislation. The pricing of the policy is determined on a case-by-case basis, taking into account a number of factors, including the tax in question, the complexity of the risk, and the jurisdiction. However, as a broad indication, pricing is generally between 3% and 8% of the policy limit required. The excess on these policies is normally for defence costs only. In order to decide whether a risk is insurable and whether a policy can be placed, the insurer will need to see a full description of the risk in question, advice from an independent third-party advisor on the tax issue in question, and any underlying documentation related to the filing position that has been taken. Essentially, you need to provide the insurer with a defence file that you would put in front of a tax authority should they claim that tax is due. Once the insurer has received all this information and asked any further questions, they will be able to indicate if they are able to insure the risk and give guidance on pricing. Typical timing for placing a policy is 2 to 3 weeks from receipt of the information and responses to any further questions. If you have any inquiries on specific tax risk policies, please contact me or your usual Marsh representative. Thank you very much for watching.